Hey, how's it going, guys? Hope everything is going well. Want to do this quick video on Brexit, the week before and the week after. It's incredible that the Dow went down 1,000 points and now it has regained all of its value. Really, really amazing move. And those traders who use Brexit, they were short before and then they went long after. Congratulations to you guys. I did have some short positions that I had before, closed some of those out, and then I went long on Monday, and I did close some of them out right now. And net right now I have some short positions, some long positions, and also have added some volatility positions as well. And speaking of volatility, found this interesting research on this. It's by a quant guy. He has his own subscription site, and he's also on that Market Timers Digest. He's been rated as the top timer compared to all of his other peers, whatever Timers Digest uses. His name is, I believe, Furry Hamsdi. I can't even pronounce his last name. But anyways, he has this really interesting indicator about the VIX. And what he does is he looks at the futures markets and he looks at the front month and he goes 3 to 4 months out and he calculates a spread, or he subtracts the spread. So what he has figured out in his research, or determined, more times than not, he has implied, when you have a difference between a 3-month spread of around 3, so if September is approximately $3 higher than the current month right now, July, then most likely this is not the best time to buy from a trading perspective. Now, if you see these two spreads converge, where you see July and September, or if you look at July and October, the spread is 0, then that may be a better time to buy stocks based on his research. And he's shown examples in the past. And what's quite interesting is if you look at the spreads on Monday, right, those spreads were pretty much equal based on the chart that I saw on his Twitter feed. So those two spreads were equal, and that was a time to buy from a trading perspective. Now, where we are right now, you see the July and the September spread, it's around 2.6-ish, right? There were times today where it reached over 3 and a little below 3. But he says, this guy Furry, 2.5 to 3 is not the time to be buying, but getting into cash. Now, if it's converging, getting a lot closer to each other, then that may be time to buy. And we shall see if this spread does work this time around, but I don't want to be adding aggressively at these levels. I want to wait for a pullback, regardless of whether these spreads are correct or not. Now, going back to the market, the way that I'm seeing it, is a bit wacky in regards to some indicators. I'm looking at the 10-year yield. 10-year yield is like 1.4 something. That is quite interesting. We saw the market rally huge the last 4 days, yet the 10-year is trading 1.4. I thought, looking at bonds, how they usually act is they sell off when the markets go up. I mean, we're not doing what Draghi's doing. We're not doing what Kuroda's doing in Japan. So it beats me why the bonds would be selling off, why people would be buying bonds, but at the same time, the market's going higher. I'm at a pause for that. And then on top of that, you want to look at the Japanese yen. Japanese yen, as most people know, this is the carry trade. The carry trade usually says risk on, risk off. If the Japanese yen sells off, that means you probably see more money going into the stock market. And what I found quite interesting, comparing last week to this week, the Japanese yen was at 105 before Brexit, and then it went down or it appreciated to 100. I know it sounds weird when I say appreciate to 100, but I'm just looking at it from the Forex numbers. When it went from 105 to 100, the dollar yen, the Japanese yen actually appreciated and risk came off. You saw the markets went down 690 points. In the morning time, what ended up happening was it went to like 102. So it sold off. And yes, you did see the Dow futures go back down to like 400 at that time. But the Japanese yen stayed steady around that range, which I found quite interesting. And what I did Sunday night, I was trading around the Japanese yen. I was shorting the Japanese yen because I felt that, hey, you know what, I could take advantage of this for the time being. And then that was actually a good move that I did because you did see weakness in the Japanese yen. Not too much, though, which I found quite interesting. Normally, I would have expected more weakness in the Japanese yen since it's a carry trade, would be risk on. And the last 4 days, Japanese yen, where is it right now? It's 102.56-ish, if I remember correctly. And the market has gone up 1,000 points. And this was at the level around that I saw on Friday morning of last week when everybody was panicking. This is really interesting. And you see gold go up. You usually see gold go up when the Japanese yen sells off. And then on top of it, what is also messed up, which no one's talking about, is that the Japanese bond market, the 10-year yield is at negative 26 basis points. Insane. Insanity. It's going to blow up in their face. When? I don't know. But another thing to know, with this market rally, we saw this pendulum swing, right? Down 1,000, up 1,000. And Deutsche Bank and Credit Suisse have gone nowhere. No one's really talking about this. Normally, I would have expected these stocks to probably regain a little more ground, but they haven't. When that Brexit situation occurred, Deutsche Bank and Credit Suisse went down hard, right? I mean, as a disclosure, I did buy some Deutsche Bank shares. It's not too money. It's not that much in my portfolio. I just have to get that out of the way. But what I find quite interesting is that Deutsche Bank and Credit Suisse have gone nowhere. So we shall see what occurs next. But it's just unusual that if you see the market going up 1,000 points, these stocks should have rallied a little more. And I'm surprised that Deutsche Bank, yeah, it has gone up since where I bought it. I bought it on Monday, I believe. And it's pretty much where it was. It's up maybe 20, 30 cents, maybe 40 cents, but I thought it'd be up $1 at least. So that's really interesting. Nothing has changed from a monetary perspective, meaning that Europe is still negative. You look at their 10-year yield, it's 12 basis points in Germany? Ridiculous, in my opinion. So what's going on in the marketplace? I mean, if you see Deutsche Bank, Credit Suisse, if these stocks do not go up if they don't move up aggressively, I would think that the market could go back down hard. You don't know what news could come out about these banks. And they've been talking about this for years. Deutsche Bank, Credit Suisse, these German banks have had issues for quite a while. The CEO had to step down, this and that. So when I'm looking at these markets, I look at now a lot of factors, right? I am looking at these VIX future spreads. I'm looking at the Japanese yen, which shows risk on, risk off. And I'm looking at the bond markets. Bond markets rallying in most places. Most of these Western countries. And then I want to pay attention to Credit Suisse and Deutsche Bank. Haven't rallied so far. Now, just because I have added these short positions doesn't mean that the market's going to necessarily go down. I just need to make that clear. I mean, you could see risk back on according to the Japanese yen, and you may see liquidity go into the stock market. Who knows? But the market has been really wacky, and you see a lot of bears, you see a lot of bulls. So if I were to take a gut guess, I would just see more of a chop. Move to the upside, you see bulls getting excited, then it brings emotions down, and the bears are going to be celebrating. It's going to go up, going to go down, going to go up, going to go down. And that's how I think it's going to be the rest of the year. It's going to be a great year for volatility, in my opinion. I said that last year. Maybe I was a year too early. But still feel that volatility is the name of the game. All right, guys. Talk to you later, guys. Bye.